Hello, everybody. This is Joshua Hayes at BigWaveTrading.com and BigWaveTrading.net coming to you with a stock market report for July 2nd for you to use on July 3rd tomorrow. First of all, I also want to wish everybody a happy 4th of July just in case I do not see you tomorrow. And let's go ahead and take a look at what's going on before the 4th of July. First off, I want you to notice the New York Stock Exchange had a horrible day today. Down 3% today. And, oops, I'm pressing the wrong button there. And I want you to remember another horrible day that it had back on 6/15 when it fell 2.95% on volume that was much below average volume, which was then followed up by a nasty 3.52% decline that, of course, came on volume below the volume average. And then, of course, after moving higher on above average volume one day and then looking like it was going to hold and possibly rally higher, it falls back again below the 50-day moving average on lower volume. Now, the good news about today's lower volume session is it is, in fact, the lowest volume that the New York Stock Exchange has seen all year long. And I believe, actually, by just taking a quick look, I can figure this out, that the 626 is the lowest amount of shares traded since 1226. So it's been over about 6 months since we've seen volume this low. And I gotta admit, pullback, it's a nasty day, but I tell you what, when volume's this low, it shows you that institutions and pension funds and mutual funds and all those big heavy money managers who are not out to dump money. Instead, what it looks like is that they were going to do their best to scare the dickens out of traders. About the only thing good going for it, if you're not scared to death by the 3% loss on its own also, is that BOP ticked slightly higher today, moving it towards the max, not the max green area, but the positive area. And also the relative strength line sure didn't have that negative a day today considering the 3% loss. And relative strength, of course, the money stream line also held up. So TSV held up, money stream held up, so did the TSV, and the relative strength even ticked up a little bit despite price falling 3% on volume much lower, the lowest in 2009. So it can't be that bad, and like I said, I want to remind you, we've seen this now happen on 6/15, and on 6/22 it scared me because it went below the 50 and 200-day moving average, or almost below the 200-day moving average. However, now I'm not going to get scared. What will scare me, though, more volume comes in on the selling. Let's say it sells off tomorrow 2%, volume picks up, and then on the next day it falls off 3%, and this time volume is above average. Yes, definitely then I would be nervous. So, you just got to take it with a grain of salt. It is what it is. It's a pretty bearish session overall because of the price losses, but with the weak volume, you can give yourself a little bit of comfort in hand that it wasn't a total, run day. And let's look at the S&P 500 to see how it matches it. S&P 500, you can see a similar situation happening in June. As you can see in June early, it was making a pretty flat base, looking nice and calm, like it was consolidation. The gains up off the March lows, it just all looked good. About the only thing that was troublesome, it really isn't troublesome as the base goes along, was the lower volume. However, it would have been nice to see higher volume to signify accumulation. Sadly, we didn't get that, as on the 15th we fell 2.38%, volume slightly ahead of the day before, but still well below average. And we had the same thing happen the very next day as the index fell only 0.14%, but did so on higher volume. Still, volume's below average, so nothing to worry about. And then, as you can see, on 6/19, the quadruple witching Friday, we came back and had a good old day, so it wasn't that bad. But the upcoming week then got bad, as the 22nd, of course, then saw what the New York Stock Exchange did, a 3% loss. The only hint that it wasn't horrible was that it was on lower volume. But anytime a price index breaks down below both the 50 and 200-day moving average after trending above them for a while, it's always bearish. So the signal was a pretty bearish signal, and it did hint to me that, I got to start taking some profits in the stocks that aren't up the most, and in the stocks I do have profits on, if they look shaky, I definitely have to get out of them. But in a chance that you do have a positive market, then, of course, I know it's crazy. And I know some of you aren't going to be used to doing this, but after a while, a lot of us get used to us. Like after this day on the 22nd, we had, for say, like 60 sells. We didn't sell all 60 of them. We sold like 20 to 30 of them, and we held the rest because they looked fine. And why did they look fine? Because as you can see, the very next day, up 0.23%, holds in there, has a little tail, and then starts to move higher. And then, of course, within 3 days, takes care of all the losses. Well, actually, almost, because in 4 days you can see it's 918 to 920. So 920, it opened up at 918 that day. Then it decided to fall down, and it closes at 920. So in 4 sessions, you're back to being higher than where you were when you started. So you get used to this kind of stuff as base building and bottoming patterns start to happen, and it's just not a big deal. It's more bullish than bearish overall. And as it went along, the S&P 500, of course, everything still looked fine. And then, of course, Friday, much lower volume. And just like I said with the New York Stock Exchange, you cannot find volume lower than this until you go back to the holiday days in 2008, which is really good. The 626 volume can only be met by the volume that was on 12/26, the day right after Christmas. So despite the heavy selling, it was more like nobody was there to buy stocks, and the only people around wanted to sell stocks. So it wasn't distribution as much as it was, I want to sell stocks, and there's nobody around to buy them. So that's what happened there. Now looking at the NASDAQ, you'll see the exact same situation. Excuse me, everybody. As you can see here, I kind of had a bad day on the 16th whenever it fell 1.1% on lower volume. However, I started to notice the distribution days creep up as I started to see a churning day, then another churning day with a distribution day, followed by another churning day, which then had 2 distribution days. That kind of had me worried, plus some of my stocks weren't looking the greatest up where they were. And then, of course, they start to look fine all of a sudden the next 2 days. It looked good after the 17th and 19th. Everything looks fine with the market. The NASDAQ's rallying on much higher volume than we've seen in the past month. And then all of a sudden, out of nowhere, after an amazing Friday, it has its ugly Monday on lower volume. And I tell you what, it wasn't as bad on the NASDAQ, even though the NASDAQ was down 3.35, as it was on something like the S&P 500, because you can compare the S&P 500, and you can see that that drop looks a lot more vicious as it takes out the 50 and 200-day moving average, while the NASDAQ remains above it. But it was still a pretty ugly session. There was no intraday support to come around. And by the end of the day, the selling continued just a little bit further. Lesser volume, but finally we were back on track. Excuse me. We were back on track and above the 50-day moving average. And as you can see, making higher highs on higher volume now. Now, granted, we did have another low volume pullback today towards the 50-day volume average. But that just means that stocks that are moving right now are more in the base building, culprit kind of area where they're looking to build out nice bottoms so that they can make major runs later on. I can understand what's happening, and I completely would love to see the NASDAQ dance around the 50-200-day moving average, and then to love to see the 50 and 200-day move lead it higher. So many beautiful green to max green bop can slim style filled charts like KONG, for instance, out there. Just in case you don't know what it looks like, I'll go and throw it up for you. Just so beautiful charts like this can just keep going. It's a very nice market out there, some very nice looking charts, but anything can happen, so you need to be careful out there, everybody. However, I gotta admit, I'm very excited. Let's look at a couple more indexes. The NYSE, I believe we already did. Even though that looks negative, still, you know, just means just stay away from those markets. It doesn't mean that they're negative. Let's see what the S&P 600 looks like. That should still be looking nice and strong. Oh, I can't even pull that up. SML-X. SML-X. There we go. So as you can see, it had another nasty 4% drop today, but however, I want to remind you, lower volume. So on Monday, if we rally back 5% on higher volume, that'll just show what Friday was, and it was just today, just to shake out the weak holders that were worried over nothing about lower prices. For right now, these one-day index wonders, they don't worry me, and if anything, it helps me stay a little bit more positive. Aloha.